You can collect all the data you want about a business, but you'll drive the wrong conclusions if you don't know how to analyze it.
So what approach do you need to analyze a business and put its performance in context? In this video, we're going to review 2 specific approaches to sharpen your analytical skills. My name is Bertrand, and I'm the founder of App Economy Insights.
And this is Stephanie Wong, tech industry veteran, engineer, and creator.
So there are 3 major financial statements, and one of them is the income statement. It shows the profit or loss of a company, or P&L for short. We are going to focus on the income statement today.
In previous videos on our channel, we covered how to read an income statement for beginners and the 5 key metrics to evaluate in a P&L. If you missed them, they are a great place to start. So now we'll put all of this into practice with 2 approaches.
So the first approach is comparison to peers and industry benchmarks. Too often, non-insiders judge a company harshly because they compare it to the wrong subset of peers. Unfortunately, it can lead to missed opportunities.
So let's look at a few examples. First, we have Microsoft. It's a 3-leg business with Office, cloud, and personal computing. Each segment has its own set of opportunities and challenges. For example, in yellow, we see the cloud segment, which can be compared to Amazon Web Services or Google Cloud.
At the bottom, in gray, the personal computing segment has a much lower margin than the rest. Why? Because it involves hardware and content production for video games. It can be compared to Apple's MacBook and iPad sales, or to Sony's gaming and network segment, or maybe to PC hardware manufacturers like Dell and HP.
Next, we have Amazon. Amazon.com is a low-margin commerce business that we could compare to a Walmart or Target, and the company is reinvesting heavily into new ventures like original content for Prime Video, for its advertising technology. The cloud segment, AWS, drives all the profit when the other segments are still loss-making.
Next, we have Google, the leader in the digital advertising market through its search advertising, which is a very high margin profile. If we break down revenue, we see that YouTube alone is 11% of the overall revenue. YouTube's performance should be compared to maybe TikTok or other video entertainment platforms like Netflix and other streamers. Google Cloud is smaller than AWS and Azure, but growing at a faster pace and gaining market share right now.
So next we have Costco. Costco has lower margins with a gross margin of 12%. And this is partly due to the company's focus on low prices. Substantially all of Costco's net profit comes from its membership fees. So that's the most important part of the business to watch.
And finally, we have Nike, the largest apparel brand in the world. Nike has much higher margin than Costco with a 43% gross margin. It's explained in part by its brand recognition. For a company like Nike, we want to compare it to other athletic brands like Adidas or Lululemon. It's also critical to look at the performance by country because the Chinese market has been disrupted by COVID measures.
Before we get to the second method, if you like this video, remember to like and comment down below. This will help us be discovered for us to bring more educational content to you for free.
All right, the second method is to compare to prior periods. My favorite way to evaluate the sustainability of a company's competitive advantages is to look at the margins over time. For example, if a margin improves from 40 to 50%, that's a 10 percentage point improvement. You can see it in the charts. However, 2 data points can show a trend, but we need at least 3 data points to show a story. So we always want to zoom out to gain insights.
Let's cover some traits to look for. Improving market share. We want to see a company grow revenue faster than its peers. It shows its business superiority.
Strong unit economics. If a company can maintain a high gross margin, it shows its long-term earnings potential.
Operating leverage. When a company's operating margin steadily improves over the years, it shows the business is becoming more efficient.
Then we have scalability. For example, a business can spend less in sales and marketing in percentage of revenue over time without compromising demand.
Path to profitability. A young business may be losing money, but what can we expect at maturity?
So let's use an example to illustrate why I love looking at the margin profile of a company over time. And let's use Netflix for that. This graph shows quarterly metrics over a decade.
So in the past 10 years, Netflix has steadily improved its gross margin, the purple line, and the operating margin, the blue line. And it has reduced its sales and marketing spending in % of revenue, the orange line. It illustrates the success of its focus on original content to grow its subscription business.
Netflix has been an incredible incredible investment over the past 10 years. And it illustrates that you don't want to jump to a conclusion just based on a single quarter.
It's critical to always remember to compare apples to apples. All companies follow accounting standards when reporting their financial performance, but keep in mind they also provide adjusted measures by excluding some items from their performance. It can be helpful, but it can also be misguiding. So we're gonna have another video about accounting standards to get you covered.
So there you have it. We've learned how to analyze a P&L and put it in context. The income statement is only one of 3 financial statements. So stay tuned for more videos where we'll break down how to analyze a balance sheet and a cash flow statement.
See you there.